Many strategic bond funds can just be enhanced versions of the local bond market. Our approach is different. We look for opportunities in all major global bond markets. And by broadening that reach, we can take advantage of opportunities across the developed world.
That can enhance return at any time, but is especially useful when economic or political cycles get out of sync. But with volatility comes opportunity, and that's where our experience and breadth of mandate comes in.
With over 50 years combined experience, Alex and I are well placed to deal with the aftermath of QE and the record number of elections we see in 2024. More voters than ever in history will head to the polls, and the potential for market disruption is huge. As a result, we've had to be nimble. In the past decade, we've seen QE, then QT, leading to bond market normalisation. But now investors face significant uncertainty, with G7 central banks themselves unsure of policy direction. Our process combines value with risk. So ahead of the EU elections, we didn't need to hold either French or Italian debt. But neither did we own Japanese bonds earlier in 2024. The central bank there being likely to raise interest rates, just as others were cutting them. In total, those markets represent around 20% of the global bond index. But as active managers, we can try to shelter investors from such local difficulties. And that meant when the price of French bonds collapsed, we were able to add them quickly to the portfolio.
We recognise the credit risk explicit in owning French bonds and discussed adding French banks instead. But most of the pain came through the sovereign side, so we just traded OATs. That's a good example of how we look at the portfolio as a whole, not a credit fund or a rates fund simply merged together. I focus on bottom-up security selection. It's important to get the credit calls right. And then David and I rebalance to our strategy, what duration, curve, or geographic risk we want using government debt. For example, we've had a strong preference for Euro credit, which we view as better value than the US or UK, and much more liquid than other smaller markets. However, if we don't want the Euro sovereign risk, we will remove that at portfolio level. Long Euro credit, short Euro sovereigns. As and when that Euro preference changes, we can quickly tilt the portfolio in other directions. Again, it's all about being nimble.
As Alex says, we have seen plenty of global, cross-market, value-driven dispersion in bond markets. And that's not unusual. Such opportunities are normally so obvious that we don't need to delve into riskier or less liquid corners of the market to add value for our clients. Indeed, our fund parameters are designed to prevent that. And so far, it seems to have worked. Although bond markets were pretty flat in the first half of 2024, we were still able to boost returns just from that core global market strategy.
There is no need to chase risk, to try to be heroes when the core, liquid market almost always offers clients with such opportunities.